Well, good evening, ladies and gentlemen, and thank you for being with me for this webinar today, The Greatest Secret Never Told. So it's a good morning to our friends in the southern eastern seaboard of Australia. Good afternoon across the ditch in New Zealand, where I know we have a number of you there. Would somebody please just type in the question box that you can hear me all right, that the audio is getting to you all? David, yes, thank you, David. That was prompt. Boy, that was quick. Well done. Thank you very much. Okay, so I've got a lot to talk to you about today, and I do thank you for being here. It's actually a very, very important webinar. Over the last year or so, I've been talking to you and doing webinars on various aspects of time. And our last webinar a fortnight ago, a fortnight incidentally, for Americans is 2 weeks. Good Lord, David, how would you know my birthday? Thank you very much. That's awfully nice of you. What I was saying, that shocked me. Yes, thank you. Yes, birthday. Another year is coming and going very shortly. Where was I? I have no idea. Okay, let's keep moving. I've been talking to you over the last 6 months, maybe the last year, pretty extensively about time cycles and how we can use time for our trading. Some of this stuff that we're going to talk about today, you've already heard at our last webinar. The one more thing in particular. But today I'm going to pull it all together for you. And I think this is an enormously important topic. In fact, I have no doubt this is the most important webinar I've ever done. And as you know, I've done hundreds of them. But this will pull together something today for you that I don't think you've appreciated. You've seen pieces of it, but not all of it. And it really is. You see, I've entitled this The Greatest Secret Never Told. And it truly is, because it's contrary to all accepted ideas of markets and trading. So let me take you there, and we'll get started. So here we are. So this statement goes into all of my webinars. I always start with this statement: markets are rational, orderly, and sometimes predictable. And you may not think that's so, particularly if you're a day trader or trading daily bars. You may well be of the view that markets are shambolic, confused, reactive, and they are those things on the smaller time frame. But what I want to show you today is how incredibly rational, orderly, and controlled markets are. And you're going to hear me using the word prescient, meaning markets know things before they happen. And it's an extraordinary story. Put on your cynic's hat. I'm an attorney, so that means by definition, I'm a cynic. I've had too many clients over the years who've told me a wonderful story, only to find them falling apart under cross-examination. Be cynical. I'm not asking you to believe me. I'm asking you to simply watch what I'm presenting to you. This is evidence. This is evidence way beyond the standard commercial level of proof on the balance of probabilities. This is approaching the criminal level of proof beyond all doubt, beyond all reasonable doubt. There'll always be doubt, but just see what I'm giving you. Have an open mind and put it all together. I expect you to be amazed. I've had over the years all sorts of reactions from clients who are doing their Danielcode tutorial. And I had a young gentleman last week doing his Danielcode tutorial. He's a very famous athlete in the southern states of America. And he's got a great passion for trading, but he's done all the wrong things, Elliott Wave and others. And when he finally got to see the light of day about market turns, he was horrified. He said, "My God," he said, they'll kill you for this. Well, that's really the comment it deserves. It's worth killing for. In fact, the reality is that so few people know, and the ones that do know don't talk about it, which I think is a great shame. In most worlds, something that's new, exciting, different, better, the absolute truth, will go viral. In our business, the most common comment I get is, "Oh God, don't tell anyone about this, it'll ruin the market." Well, it won't. This has been going, I've backtested this stuff to 1924, 1926. This stuff has been going a long, long, long time, and it's not going to be changed by John Needham or anyone else. The markets run the way markets run, and after today, I hope you're going to understand that. And it's a staggering secret, and it's crazy that it's a secret. It should be the best known market theory in the world, and it's not. And think about our financial world today. It's largely based on random walk theory. Random walk is the most widely known and most widely accepted of a number of market theories. And basically, random walk theory implies it's impossible to beat the market without assuming additional risk, and that fundamental analysis is undependable. So, according to random walk theory, it's impossible to consistently outperform the market over the long term through stock picking or market timing. However, here's the big buzz. This is the advertising pitch. It is still possible to profit in the stock market by buying and holding a diversified portfolio of stocks, such as with an index fund. Well, that's just puff. That's marketing. The whole of the world of markets and trading and stocks and investing is huge. However big you think it is, triple it. It's massive. Governments all over the world give incredible tax advantages to people for investing in stock markets. And stock markets have a vital purpose. They're the simplest and most capital efficient way of raising capital, new capital for worthwhile companies. I get all of that. I understand all of that. I've been a director of several public companies over the years, and I understand that. I've also been an attorney for the stock market, the Australian Stock Exchange, which was I think it might have been the Sydney Stock Exchange at the time. It was a long, long time ago when Jim Cooper was the chairman of the Sydney Stock Exchange, now the Australian Stock Exchange, and wonderful man, Jim Cooper. He was my godfather. Wonderful man. Anyway, I digress. So this random walk theory is actually much older than you know. It started with a 1965 paper by a gentleman called Eugene Farmer. He was an economist. But then in 2013, this theory, which also involved Robert Shiller, who's very, very well known as a market economist, they were awarded the Nobel Prize for economics. And that, of course, took this to knowledge of it, at least, and awareness to a whole new level. And this is a huge business. This is a huge industry. Just think of the number of people you know who are employed in one way or another in a financial industry, whether it's a commentator, whether it's a clerk, whether anything you can think of, any level. It's a huge, huge business. And investing in markets is the bedrock of our financial system. And all of that problem goes on and on because the big problem with random walk theory is that it is wrong. Now, I can qualify that by saying on its narrowest way it was taken and the narrowest way the argument was put, which is simply looking at the prices of daily bars, they don't forecast future price levels. That's true. But as any good attorney knows, the answer you get is going to be a function of the question you ask, and they've simply asked the wrong question. It doesn't matter what the price levels today are in regard to price levels in the future, because that's only half of the equation. Every market, every chart on every market, every bar has qualities of both time and price. And If you leave out time, you've immediately lost 50% of your information. And it's generally accepted, and I think you'll be pretty well of the view after today's session, that time is stronger than price. And I'm going to show you a couple of the really amazing things that you would honestly be happy to put your hand on your heart and say, no way. But it is, and it does. And that's the difference when you start thinking and talking about time. The amazing thing about markets is that no one does talk about time. No one, as far as I know, understands time. And the only pieces of information I ever find when I'm searching for knowledge on time cycles in markets is weird stuff, Mars retrograde or something of that nature. We don't do that. We're very realistic people. We're also very cynical people, as I've told you. And I won't tell you anything unless I can prove it to at least my satisfaction. And if I can prove it to my own satisfaction, the probabilities are that I can prove it to your satisfaction. So be as cynical as you like. I think being a cynical person, being cynical about information is a very good base to have. And it served me well over the years. Now let's take this a bit further. So what is the truth about financial markets? Well, the truth is that random walk theory and efficient market hypothesis, if you like, or most of those, Dow theory, there's all sorts of theories. They all have the same problem. They forget to ask the question about time because people don't know about time. I've been actually talking about this since 2007 when I started writing for Financial Sense, and you can see all of my articles at the Danielcode website. You can also see a lot more than 100 webinars there. There's several lifetimes of knowledge for you people. It's all free. Help yourselves. And I hope to push you towards the idea of sitting and thinking rather than doing something. Just think for a while. Let this stuff soak into you. So on the narrowest basis, random walks idea that asset prices occur at random and therefore do not affect future price movements, that's okay on an individual bar basis. I can understand that. And this all started longer than you can think. A gentleman called Malkiel in his 1973 book, A Random Walk Down Wall Street. But if we restate the question that they asked to include time, which we should, time is real. All of your life is lived, whether you like it or not, by time. What time do I have to leave? What time will I meet you? What time is the event happening? What time do the races start? Ask most questions, what time's dinner? And they're related to time. And our lives are ruled by time. So why is it that no one has ever thought about time in markets on a workable, rational, sensible basis? This is not market timing. This is a statement of how markets actually work. And if you don't understand the real basis of market movement, not only the why, but also the when, you fail to grasp the simplicity, the rationality, the order, the sheer beauty that controls markets. And the way that markets turn and react at precise points is the basis for Danielcode, and it's based on time. At our webinar 2 weeks ago, the One More Thing, I showed you how we take time ratios and we simply convert them from vertical to horizontal and put them on a chart and call them time targets. And they work like a dream. They work better than anything you've ever seen in your life. Markets find those numbers and keep finding them all the time. So adding time to any market chart is simply akin to turning on the spotlights. You will never see financial market charts in the same way again. So remember that random walk theory is essentially a theory by economists for economists. Danielcode is for market traders and thinkers. Those of you who've been with me for a time have read some of my earlier articles know that I always equate economists to witch doctors. They've got plenty of ideas and plenty of theories, but they can never tell you when it's going to happen. And that's a basic fault of all economists. And of course, that has happened in the search for random walk theory. So think this through. Every bar on every chart has elements of both time and price. So it's a wonder that such little information on time cycles and their steel-like grip on financial market is pondered, discussed, and considered. But let me chase that for you. Danielcode time is a unique group of ratios from a historic document. That's a statement of just 15 lines. It gives us from there, it gives us two numbers and a statement of how time progresses. That's it. That's it. Just let that sink in. That's it. Two numbers and a statement of how time progresses. Well, from those two numbers, with some simple mathematics, the first thing we come up with is the rule of eighths. Why is that important? Well, not so important now, but until decimalization, all stocks were quoted in eighths. Very, very important. Today, some markets still are. Grains are quoted in quarters, which is 2/8. UST bonds are quoted in 30-second. A pip, a tick is 1/32. That's 4/8. That's the same rule. It's the rule of eighths, but they've had to multiply it by 4 because bonds move so slowly no one would trade it unless they put the gearing into it, and that's the gearing. So we start off with this unique group of ratios that come from that document. And the most important is the first one, which is 29.6. We call that time. That's a measure of time. It's not the only measure of time. But to us, it's the most important measure of time because everything else flows from it. 29.6 days is almost identical to the length of a synodic month, an average month, which is 29.53. If we're dealing with these very, very old historic documents and numbers, in my view, it's vital that we can compare them and contrast them with a known modern scientific fact, and that's what I'm doing for you here. I'm telling you the Danielcode time is almost exactly the length of a synodic month. That the Danielcode sequences for a year are accurate to 2 hours a year. 2 hours, that's all. And this document was created, written many, many centuries ago. I mean, a lot of centuries, a couple of centuries, in fact. And the first thing it gave us, where we put some mathematics into it, was the rule of eighths. And that was important because that gave me the courage and the enthusiasm to continue this search for the Danielcode, which it's still going. It took 7 years of pretty much full-time work. To say I'm obsessed about markets is putting it very mildly. I think about markets all the time. I dream about markets. It's been my quest for the last 30 years, a significant portion of my life, to understand markets. And you can't understand markets unless you're talking about time. So, basic number for time in the Danielcode lexicon is 29.6 days. And it expands by half. So the next number in the sequence is 44.2, then 59.3, and so on. The way that markets progress, according to Daniel's code, is time, times, plural, and a half. In other words, market sequences of time, in fact, any sequence of time, whether it's related to markets or otherwise, they repeat, they expand, and they halve. And that's it. That's all they do. So we're going to start with the macro, our long-term charts, which some of you have seen, 24-day charts. Every single bar on a 24-day chart is made up of 24 trading days. So let's just look at very big pictures of data. But it also shows you the most dynamic of these signals, and if you can see those and understand how they're created, you're going to own the world, because you can always argue from the macro to the micro. So, as I said, this is proof of a revolution. And some of you are part of it. This is a document that I showed you at our last webinar 2 weeks ago. This is gold. We're going to have another look at gold, a different look at gold today. I just wonder if my old mate from Reading is with us. He's a king of the gold bugs. Let me see if he's here. Lots of them here. Oh, Gig's here. Greg Hilton's here. Jeff's here. Jonathan from New Zealand's here. Mark L's here. Pancho's with us. Peter's with us. Two Peters. Peter Mack, who is not a day trader. Rolf down in Melbourne's with us. Oh, look at this wonderful turn up today. Absolutely great. But I don't think our friend from Reading is here, but he will be. And he'll see the video if he's not available today. Okay, back where we were, folks. So time and price are the same thing on different axes. If you don't believe that, go and have a look at last week's webinar, please. It's called The One More Thing, in which I take you through a detailed study of a 6-7 month period of a gold chart and show you how you can find every high, every low, and every time circle. That's what we did last time. Let's move on now, because today, here we are. We're going to start by looking at the S&P. We're then going to go on to T-bonds, and we're then going to go on to gold. I want you to understand that these rules that we're going to be discussing are universal. And don't get frightened by this stuff. It's really very, very simple. When you see all the little numbers and bars on a chart, don't throw up your hands and start worrying. Be grateful. This is a gift. This is the most marvelous gift that I can give you. This is the knowledge of what markets really do. And what we're going to be using with all these numbers, as you see, is we're simply taking the basic Danielcode numbers, 29, 44, 59, 70. You know what these numbers are. They're on your retracement tool if you're subscribed to the Danielcode website Pro. You've certainly seen and heard me speak about them many, many occasions. Have a look at this chart. This is the index. This is the S&P index. I'm largely talking about futures today, but I want to make the point that it's exactly the same if you're talking about the cash or the index, as the case might be. Have a look at this. This is the S&P. This cycle is starting off way back, and I mean really way back, on Black Monday, August 1987. The stock market crash was worse than the Great Depression. There it is, sitting on your chart. Does it mean anything? Well, if you saw last week's webinar, you'll remember somewhere along there I pointed out that for the market to be able to create the Danielcode price targets, it had to know the highs and lows going back 6 or 7 months, exactly to the tick, and that's what it does. The market has a memory, certainly a better memory than any of us do. Here it is, 1987 August, Black Monday, infamous, dreadful. The Dow was down 22% in a day. Can you believe that? Okay, so we're starting all the way back there. Look what happens from there. Look what happens with the 70 cycle. It simply rolls on through all the way from 1987 to 2007. And it gives us the closing high of the whole of the move, the rally up from 2002 to 2007. Have a look at the 44 cycle. Those of you who've been with me for a while know that 44 is the cycle for gold. I wrote an article back in, I think, about 2007, and it's called Masterclass 2, Timing Gold. It's available at the Danielcode website under the articles tab. It's free. Everything there is free. Read it, I beg of you. All the way back then, I proved that the basic rotation for gold is 44. Look at this, all the way back from 1987. If we put the 44 cycle on this chart, because although it is the prime cycle for gold, it's very reactive in equities as well and other markets. Look what happened. The code here says 2, but that's because the tool I'm using has not been built properly. It's actually 3. 3 lots of 44 cycles, or 132 cycles from the Black Monday super crash. What do you get? You get the high of the dot-com boom. Remember that, some of you? It was wild. Eyeballs, clicks, anything goes. Prices, extreme, extraordinary. So simply from that basic start there, with 2 basic known Danielcode ratios, we get the dot-com high and we get the 2007 high before the collateralized debt obligations, collateralized mortgages, caused the crash down to the low in March 2009. Why is this important? Well, I'm not talking about ancient history. This is going to take you right up to now. This is how markets work. Markets have long memories and big cycles. Have a look at this. This is where it all started. Back in 2007, at the high in the S&P, this is the index, I noticed that the market went swing high to closing high in 59 days. That excited my interest because 59 is the second number in the Danielcode sequence. 29.6 times 2 is 59.3. I saw that number there. Why do we not worry about the 0.3s and the 0.6s when we get to charting this stuff? Well, remember that almost 1/3 of bars are not even on these charts, are never on these charts. That's weekends and public holidays. So we should have a consistent error of 33% or pretty close to it. The fascinating thing is we don't. Markets seem to understand that and compensate for it. You won't find me giving you a chart that says, oh, well, look, we were within 3 bars of something. Forget about that. This stuff is precise and perfect. It works to either the closing high, closing low, or it works to the swing high, swing low, and that's all it does, and it does it all the time. What happened after that is we saw that we had a 59 cycle into the 2007 high, and we looked for it to repeat. The most common things that time cycles do is they repeat. And we looked for this to repeat, which is what it did. 59 went from the closing high to the closing low. Exactly. Did I invent this recently? No. I wrote an article about this back in 2009. You can see it on the articles on the Danielcode website, and it was published by Financial Sense on the west coast of America. And in which case, amazing things happened at the lows. 666, the number of the beast. That's the name of the article. Read it. You'll be amazed. Here we are. Still showing. WP says Greek. No. Gig, just a moment, please. No, we're right up to date here. Gig, you might have a very slow connection there. Anyway, that's where we started. Let's move on. And from there, look what we get. Here's the 2007 high down to the 2009 low. What do we have? Remember, it was 59 cycles on the 6-day chart. We've now moved to the 24-day chart, and we're looking for markets to repeat, extend, and halve. If you take 59 from the 2007 high, what do you get? You get the October 2018 high. That gave you the biggest correction, really, since the 2009 low. And if you took the same 59 cycle and used it twice, because cycles repeat, what did you get? You got the COVID-19 flash crash high from March 2020. How is that possible? They're the two most significant corrections on this whole chart. Dramatic. The COVID crash was a instant flash crash, 24 days, I think. That was it. Shortest bear market in history. It was all over. How did it happen? Why did it happen at a known Danielcode ratio? That's the question. Okay, and what do we get from that? Well, we know that time cycles progress as time times and a half. Pretty simply, we know that 70 is a confirmed cycle. You've already seen that. It's a known Danielcode time cycle. After we've used the 59s in singular and as plural, what's left? And half. And half of 70 is 35. And from the October 2018 high, that takes you to the 2020 January high, the all-time high in the S&P. Amazing stuff. What about this? Discrepancies matter. This is actually a chart of the S&P index. I don't have that heading on, and I should have, and I do apologize. This is a little bug inside the program we use to create these tools. It tends to cut off the head sometimes if you ask it the wrong question. Anyway, have a look at this. You've been looking at the 2007 high on the futures. This is the index, and it's different. Instead of it being 80 high to high, it's only 79. Why is that? Most everyone would say, so what? Plus or minus 1 day, close enough. 1 bar rather, close enough. No, discrepancies matter, and I'll show you why they matter. Take a look at this. What we've done now is we've taken that 79 from the 2007 high in the S&P. 79 the first time is time. At 1.5 times, it gives you the high, the all-time high. At what says 1, which is actually 2, remember I've told you this program doesn't count the first cycle, that gives you the low. There's the high and the low, simply using the 79 discrepancy piece that the index showed us. Don't throw it away and say, what does it matter? It does matter. Have a look at this. It matters. Time not only matters, time is everything. We also put a 59 cycle on here because we know it worked on the 6-day chart. Probabilities are it's going to work on the 24-day chart. Here it is. 1.5, which is actually really 2.5 times 59 cycle from the 2007 high, gives you the January 2021, 22 rather high in the S&P, the current all-time high in the S&P. What about this? This is a futures chart. Look interesting? Just have a look what it runs April 2000 to 2007, high to high. And let's just simply take that and repeat it. Let it repeat. Cycles repeat. It's the most common thing. Twice that high to high, which as I've told you is really 3 times. There's your low in November 2022. Random? Index? Hardly. Nothing's random. It all has meaning. Okay, so a Danielcode trading tutorial, folks. If you haven't done one, now's the time to do it for April, May. I've got a new offer for you. You tell me what deferred terms you need. I'll try to accommodate you. And here's something new. After today's cycle analysis, we're creating a new teaching module in the Danielcode tutorial, which is long-term chart analysis. Ask for that tutorial. It's going to retail for $4,500. If you're in the first 4 people to email me, jneedham@thedanielcode.com, and tell me you're ready to do a tutorial, you can have it for free. You can have a $4,500 gift from me just for being here with us today. jneedham@thedanielcode.com. Learn everything worthwhile about creating and trading code Danielcode time and price signals. time trading will blast you to the next level. It'll also blast your mind. I told you about the new guy I've got who's, my God, they'll kill you for this. It's exciting stuff. They won't kill me for this because hardly anyone knows about it. Your job is to make people know about it. You should be talking about this. We should be excited about this. We should be celebrating this. This should be a big, big event. Have a look at this. Here is the S&P E-mini running from the 2009 low. There's your 79 cycle. You've just seen it on the index. Have a look at it on the futures. Exactly the same. There's the high. And the cycle before it gave you the high of the COVID-19 flash crash exactly to the bar. The next cycle, another 79, gave you the high, the all-time high in the S&P. Where does this number come from? Well, we know that the high to high on the futures chart 2007, 2009 was 80, but on the index it was only 79. That's telling us something. That's screaming something at us, and you're looking at it now. There's a cycle straight out of the market. The market is instructing us and telling us what to do. Markets are actually talking to you all the time. I know you don't understand that, but they always have been. Problem has been, until the Danielcode came along, we didn't have the tools to understand what the market was saying. Now it does, and in the process of doing a tutorial, I'll show you how markets are talking to you all the time. Important stuff. Have a look at this. Those two cycles, the September 18 high and the March 2020 high, are very, very important. They're the cycles that the Danielcode time signals picked out exactly to the high bar, not plus or minus one, exactly. I don't know how it can be done if you've got a standard variance of 32% by missing bars. How can the market do this? I mean, it's incredible. It's magic. It's marvelous. It's just something that's so exciting. We don't think about it enough. What we've done here pretty simply is we've just taken the gold cycle 44 and at the top level we've slapped it straight on our September 2018 high. That gives you the low at two cycles, straight out. 44 repeats, time, times, and a half. And below that, we've simply put the 29 cycle on. Okay, 29, 44, 58, that should be 59. This is counting 0.4 light. But it's not bad because it matches exactly where the 44 cycle said the low was likely to be. And there it is. What's next? We're now looking about thinking about COVID-19 running rampant. Absolutely. Well before March 2020, there were millions of people dying all over the world, and it had absolutely no effect on markets. Then suddenly it mattered. COVID flash crash, 24 days, I think, or the shortest bear market in history, at least. And then it was over. On this chart, it's 2 days down, 2 bars down. This is a 12-day chart. 24 days down. That was it. It's all over. Market starts rallying, roars up to new highs, and runs from the COVID low to the January 2022 high at the fastest sustained pace that I can find on any S&P chart. It didn't matter. Then it mattered. Then it was over. How does that work? Well, it works because of the Danielcode time cycle. That time cycle, exactly marked by the 59 cycle from the 2007 high, the 2009 low, those 59 repeating 59 and 59 gave you both that September high 2018 and the March 2020 high exactly, precisely to the bar. Okay, have a look at this. What we're using here is simple swing analysis. We're highlighting the market moves and we're using the length of those swings to create its own time cycle. You can do this. This is a daily bar. put it on the length of all these swings, major ones, use them as time cycles. Look what it does. Highs, lows, amazing stuff. Easy to do. Now we're moving on to T-bonds. This chart that looks an absolute fright to most of you who have not seen it before is our long-term trend chart of US T-bonds, and I've been showing you this since 2007 periodically. Some of you will remember that at this pullback, which happened in March 2020, right at the end of March 2020, we had a high at the 89 cycle, and it's been down since then. And we've been talking about it. I've been saying to you, is every one of these support levels on this angular chart, this is the fourth seal chart, angles all have elements of time and price. We've been talking about, well, that's the next level, now it's gone. Here's the next level, now it's gone. Here's the next level, now it's gone. It even got down to me putting these little red marks on the right-hand side, 125 correct 10. That was a target. It got there. The next target was 114 correct 21. It hasn't got there yet. It may, but it's caught every other target. This is incredible stuff. Here's that same chart cleared up without all of my history on it. What have we done? We've gone from the high in October 1998 and the low in February 2000. We've put a 70 cycle on from the high, and it's given us the all-time high in bonds. Exactly, specifically, perfectly. The 44 cycle, which is run from the low in February 2000, it's given us the low in bonds at 4.5 cycles, which is really 5.5 times 44. And it's done it perfectly to the bar, exactly. Time rules. You've had this chart for years and years and years. Pretty marvelous stuff, isn't it? Time controls markets. Have a look at this chart. This is a pretty interesting little turkey here. This is UST bonds. This is your payoff for having a knowledge of time cycles and how they rule all markets. What we're doing, and you'll see on the next chart, this doesn't look too exciting because we haven't got our swings on it. If we move to the next chart, now you can see that I've simply put on a 29 cycle swing. Okay, and I can tell you that this has, since this high in August, this has returned about $64,000, which is massive, huge, amazing. It's not as simple as it looks. I want you to understand that, because the key to this is what we're doing is we're taking time cycles and time signals, and they have to coincide. And the issue is that you have to be aware. You have to, in fact, assess when the swing is going to end, because that's our big trade. We had a buy in UST bonds for today. You'll all know, and we've got a lovely big bar on it as well. But that one up bar today completed the 29-day down cycle into the previous day. It looks great when it's over, but you have to actually estimate when these time cycles are going to occur and trade accordingly. And because we have less than perfect ability to do that, what we do is we finish up getting a whole lot of other trades that are not shown on this chart, which may break even. Some of them may be losers. If you know how to trade using the Danielcode trading rules and flip me, etc., you do lose about $16,000 over that same period. But net, you're talking about 60,000 plus on a very sophisticated but simple trading program based on time. Okay, we have to move along. I must be talking too much today. And have a look at this gold. Very important. I know all you gold guys are saying, yay, let's get into this. Every important high and low cycle comes at a Danielcode time cycle. This is a daily chart of gold with some of the time cycles on it These are not the only time cycles. There are also some smaller time cycles which require some managing, but I wanted to show you how amazing and dynamic these time cycles are. We actually have clients who trade exactly the chart you're looking at, a 29 cycle on gold. And they don't want to know anything more. Just let me at it. And they do very, very well. But there is more. Have a look here. This is the start of our long-term gold chart. Where does it start? Back in 1999. Pretty obscure, isn't it? That was the swing low in August before this market started to really take off. And then we got the big boom up 2 months later to October. So remember that to date I've been showing you time cycles running from swing highs and swing lows. We have the same thing here. The market tells you where to start. This is a bit unusual because the difference between the swing low and the swing high is only 2 months, but it works exactly the same. Have a look at this. This is a 24-day chart of COMEX gold, and I put 2 cycles on it, and they're the same. 44. Why is that? 44 is the dominant time cycle for gold. You can go to the articles tab if you're interested and read the article Masterclass 2 Timing Gold. Will explain all of that to you. Look what I've done. I've put on a 44 cycle from the October 1999 high and exactly the same from the August 99 low. This is what it gives us. That was not too exciting, but look what happens when you add the Danielcode ratios. Here it is. Every single high, every significant low is happening at a Danielcode time cycle. And I put all the time cycles on the chart. There are 2 lines of 44 cycles. One is the upper or high line, which have an H after it. The one underneath is the bottom or lower line, which has a capital L after it. So when you see that the high came September 2011, the previous high, came on the 14 cycle on the 1.5 low bar. You can see the number 1.5 is 110 cycle. Put your time on that. 14 days from that gave you the high. Look at everything else. 50 on one high, 89 on 0 low. That's the 0. You can't see it. It's off this chart. What about the latest highs? Well, August 2020, 89 on the 1.5 high line. Find that 1.5 high line, run 89 cycles from there, bang, you're at the all-time high. And the low, 74 on 2.5 times high. And the next high, 62 on 3 times high. Look where we are now, 74 on 3 times high. Every important high, every important low has happened at a Danielcode time cycle, a known Danielcode time cycle. And there you are. That's the magic. Okay. Alternately, here's another offer for you folks. If you are able to start your tutorial before the 12th of March, you are welcome to claim a 20% discount off our normal tutorial price of $7,500 and save yourself $1,500. Okay, that means you don't get the long-term trading tutorial, but you can save a bit of cash instead. And these days, that's always important. Email me, jneedham@thedanielcode.com. This offer will extend only to the first 4 people. Why do I keep putting these little short time cycles on? Well, I do these tutorials myself, and I'm at the other end of the world, so we run them from basically 8 p.m. US Eastern Time through to as late as you like. But once we start someone in these tutorials, they keep recurring and recurring, because as the work progresses, so we need to go and check what they're doing, review how they've done their piece of paper trading or whatever it is I've asked them to do. So we have to keep a fairly tight rein on these time slots, otherwise they get completely out of hand. But there's an alternate offer for you. If you would just like to take a cash-sensitive deal, take 20% off the price. Let me know in the next few days. We'll get you booked in. So today we've talked pretty much exclusively about time. What about price? Well, it's really simple. We've been bashing the 2007 to 2009 low. How many of you've taken that run down from the 2007 high to the 2009 low and added it to the 2007 high? Because if you did, at 4.5 times that whole pullback, exactly 4.5 times that pullback, you got the January 2022 high. At 3 times that pullback added to the 2007 high, you got the high of the COVID flash crash. Do you see? Time, times, and a half. Time and price are the same thing on different axes. Here we are. What about the pullback? We have 2 different swings in here that are really important. We have the first swing down to the January 2019 low, which was that swing for the 2 Danielcode 59s forecast at the high September 2018, and the same in March 2020 for the COVID flash crash. Look at these 2 retracements. I put the numbers on them for you. 50% of the minor swing, 59% of the major swing. Pretty interesting stuff, isn't it? Controlled, accurate, precise, prescient. That's what markets are. It's hard to see that sometimes. How about this? This is time, times, and a half. This is one version of it. Time, 55 in there, then times to 110, and a half. Gave you the high at 138 cycles from the March 2009 low. Sounds complicated? Have a look at this. Time, 59, times, double it, and then half, 29. 29.3 is half of 59.6. Time, times, and a half. The never-ending cycle. Exactly what Daniel's code told us so long ago. Exactly what I've been working on for the last almost 30 years. And it's monstrous. You should be celebrating. You should be screaming. You should be shouting everyone at your golf club gig. This is the absolute knowledge and understanding of what actually makes markets turn. And it's so precise, it's so perfect. Why aren't all these numbers plus or minus 3 bars? Because there's 30%, 32.7 actually, 31.7, almost 32% of data bars are missing. They're not on this chart. They're not on any chart because of holidays and public holidays, weekends and public holidays. But we're not getting that here, are we? We're not saying this is plus or minus 3 bars. We're not saying this is accurate to a third. These numbers are showing up and recording every significant high and every significant low on a range of charts. And we've gone through the S&P, we've gone through bonds, we've gone through gold. 3 totally non-correlated markets. They all behave exactly the same. They behave according to the Danielcode rules. And your job, as well as my job, is to talk about it. If you know someone who's interested in markets, send them this recording. Get the link as soon as Terry posts it. If you know someone who's a journalist and thinks they're a financial journalist and know about financial markets, send them this link. Ask them to at least see it and think about it. This is earth-shattering stuff. I am super excited about it. I hope you are too. This is what happens all the time, every day. Okay, so remember why tell them? Well, it's my obligation to tell as many people, and it's not going to affect your trading, I promise you. Make this big, make this better. The business of trading futures and forex is not to be right. The business of trading is making money. And if you haven't already, folks, please help yourself to a free trial of the Daniel Code. Just go to the website, www.thedanielcode.com, log in. If you have any problems registering, contact Terry at support@thedanielcode.com. If you previously had a trial with us, the website will remember that and won't want to give you another one. So contact Terry, let him know the issue. He'll sort it out really quickly. Finally, this is our disclaimer, which we're obliged to show you, and I always want you to read it, and I want you to take it seriously. Losing money at trading is very, very simple. In fact, 99% of new traders lose their bank in the first 90 days. That's what the industry thinks. I think they lose their money in the first 30 days because they don't know how to trade. Take the time to learn. Be sure that you understand trading markets before you risk any real money. Apart from that, thank you for being with us today, and best of good luck. Some of you, at least, Jeff, thank you, and Akshay, here we are. These guys think we are crazy, but I know different. That's Gig. Gig's a big trader, big golfer, lovely man. They should be told, they need to be told. What people are paying fortunes to learn, and I do mean a fortune, about markets, about how to trade. What do they get? Random walk theory and a bit of Elliott wave. Poison. Learn that the Daniel Code rules all markets. Thank you for being with us today, guys, and look forward to having you as my guest at our next webinar, which will be in a couple of weeks' time. Any questions, please email me, jneedham@thedanielcode.com, and I will be happy to answer any of your questions. I will also be happy to include any particular material that you'd like me to think about before our next webinar. All the best for now, and bye-bye.